Welcome to FitMoney's flipped lesson for our investing unit lesson 4, which is titled Diversification. In this lesson, we're going to help you understand the definition and the purpose of diversification. We're also going to further look into savings and investment products if you need extra research, because you are going to create a sample portfolio and see if you can boost your performance by using the idea of diversification. So first, let's think about this. What do you think the saying, "don't put all your eggs in one basket," means? What advice is that giving you? Usually when we say this, we mean don't risk everything you have in one area. When we think about it financially, this relies on the concept of diversification. We'll ask you to watch this video in just a minute, but first, let's talk about a little bit of vocabulary that goes into diversification. Diversification is reducing the risk of losing your money by having your money in a number of different types of accounts or products. So a nice mixture of risk. An asset is something that you own that has value. So it could be a stock, or it could be a savings account, it could be shares or a mutual fund, or it could be any personal property. Volatility is a word that we use to describe the chance that something will change wildly, and it has a negative connotation, so it usually means that if something's volatile, it could change for the worse. Your portfolio is any combination of financial assets like stocks, bonds, and cash. So your portfolio would be a combination of all your different financial assets. As you watch, think about this question and then answer it on your Creating Portfolio handout. And that question is, what is the meaning of the word diversification? And what's the purpose of diversifying your accounts? Now you'll watch this video to learn a little bit more and keep these words in mind.
Have you ever heard the old saying, don't put all of your eggs in one basket? In spite of the small percentage of us who have ever collected eggs in a basket, the simple wisdom of this proverb is universal. Namely, if you put all of your eggs in one basket and you drop that basket, you won't be having an omelet for breakfast. However, if you divide your eggs across multiple baskets, dropping a single basket isn't a disaster. When it comes to investing, the same principle holds. If you invest all of your savings in a single company and that company goes under, your entire investment is lost. But if you invest your savings across multiple companies, the poor performance or even bankruptcy of one company isn't the end of the world. This principle of spreading your investments across different assets, called diversification, was first explored by Harry Markowitz in the 1950s. In fact, he received a Nobel Prize for his work in the area. He suggested that while investors are looking to maximize their investment return, they also want to minimize the volatility associated with those investments. The desire of investors for a higher return is not surprising, but what is volatility, and why would investors dislike it? Volatility is a measure of the ups and downs of an investment. If you receive an investment statement in the mail each month and check your balance, you hope that the dollar amount listed on the statement is higher than the month before. But when you invest in an asset with higher volatility, that balance is more likely to have large swings in value. If you open the statement once a month, knowing that you need money to pay for a large expense like buying a car, and the balance happens to be down, well, you get a sense for why investors dislike volatility. As investors, what can we do to decrease volatility? Markowitz suggested that the answer is for investors to diversify. By spreading out our investment dollars across multiple assets, we can reduce the volatility of our portfolio. As an example, consider investing in U.S. stocks. The Standard & Poor's 500 is an index of the 500 largest publicly listed stocks in the U.S. If we were to select just one of those stocks and invest $100,000, the ups and downs in our portfolio would be pretty severe. However, if we invested equally in 5 stocks or 30 stocks, the ups and downs are significantly reduced. Because the stocks have different ups and downs, combining them into one portfolio helps to smooth out the ride. If investors diversify their portfolios across different asset classes, namely stocks, bonds, real estate, etc., the volatility decreases even more. Now, not everyone agrees that you should diversify. Mark Twain once wrote, "Behold, the fool saith, put not all thine eggs in the one basket," which is but a manner of saying, scatter your money and your attention. But the wise man saith, put all your eggs in the one basket and watch that basket. Although the quote was made tongue-in-cheek, it's a perspective that some investors embrace. While I wholeheartedly support the advice for investors to watch their basket, even the savviest investors cannot predict the outcome of all of their investments. In those surprisingly frequent cases when all the watching in the world can't help most investors avoid a big loss, diversification has the potential to soften the blow.
So what did we learn from the video is the purpose and meaning of diversification. The meaning of the word diversification, in this case when you're investing, is investing in many different types of accounts and products. The purpose of investing your money in lots of different accounts and products is to minimize or reduce the risk of losing all of your money. If one account or product tanks, you've still got the money that's in the other accounts and products safe. It is the hope that if you've got a lot of different assets, you're at less risk of losing money because if one or a couple of investments do poorly, the other unrelated investments are successful enough to balance out your losses. So let's say you own stock in two companies and one company goes bankrupt. That stock won't be worth very much, but hopefully your other stocks are maintaining their value. Can you think of a different equivalent to the saying, don't put your eggs in one basket? Now you're going to return to the build your stacks game. If we were in a classroom setting, we would ask one of you or small groups of you to become experts on each of these types of investments. You have strong definitions of them on your worksheet in case you need them, as well as this slide on index funds, you're welcome to pause and read into, and this slide on commodities, since those are two fairly new items we haven't talked about yet. Feel free to return to this slide on index funds or this slide on commodities if you'd like more information. What you're going to do now is use your portfolio handouts to plan your portfolio. So first, read up on the Creating a Portfolio worksheet about each type of asset and what you should think about when you decide to invest. Next, use the My Portfolio page to start thinking about planning out how you're going to invest in the Build Your Stacks game. We're going to try and compare your performance today when you've done some planning with your performance in the previous lesson when you were just playing Build My Stacks for the first time. After you've planned out your portfolio, log back into buildyourstacks.com and go ahead and try and see over a 20-year timeline whether your portfolio improves. Once you finish playing Build Your Stacks with the My Portfolio sheet, we'd love for you to think about the following question. How did learning about diversification and the different products inform your portfolio planning? Did you do any better this time than when you played Build Your Stacks with no background? For the next lesson in this series, continue playing on our playlist for our investing unit for FitMoney Flipped video lessons.